Welcome to a special edition of Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square for a fixed income panel, we have Jayni Kosoff. She's the head of fixed income ETF strategy and business development over at FTSE Russell. We also have Diana Sands, fixed income portfolio manager with Goldman Sachs Asset Management, and Nasdaq's very own Steve O. He is the head of product and ETF listings. And we're going to take a look at new approaches in navigating the fixed income market, which has been such a hot topic for 2019 and I suspect in 2020 and going forward as well. Thank you so much for joining us at Market Site. We'll just go right down the row here. Jayni, and your thoughts around how the fixed income market has evolved.
Absolutely. The traditional indexing approach would have been about tracking markets and providing transparency. And these days, we're just finding a lot more focus around being way more systematic, being more insightful, bringing in a lot more information to just be thoughtful about benchmarks. And it leads to some of the trends that you're seeing in smart beta, alternative beta, and also actually the same kind of information is required as you look into ESG, which is very much on the forefront.
All right, and Diana, from the portfolio manager's point of view.
Sure, I'll certainly echo what Jayni said, which is, there's been an undercurrent in our market sort of questioning original indexing, and particularly in recent markets where you've seen just enormous growth in fixed income issuance. Clients, particularly looking at, for example, credit, will say, you know what, I don't want to invest in a traditional index because there's been so much issuance. You're just investing in companies that just have a lot of debt outstanding, and is that actually a good thing? And we take it a step further and say, just because a company has a lot of debt outstanding actually doesn't tell you much about that company's ability to meet their debt service payments. It doesn't tell you much about their health. And so, exactly to Jayni's point, can you use data in a smarter way in your index construction? Don't throw the baby out with the bathwater. Don't reconstruct fixed income indices from scratch. We still think there's, real merit to how these things were constructed from the beginning. But can we make tweaks to bring a more nuanced approach to actually investing?
All right, and Steve, I would imagine from the products and listings perspective, there's a great opportunity there.
Yeah, I mean, fixed income ETFs have been one of the fastest growing areas within ETFs. Fixed income ETFs just hit $1 trillion in total U.S. assets this year. And with the advent of the ETF rule and custom baskets, fixed income ETFs will be one of the biggest beneficiaries.
Right, and I would imagine too, having it in the ETF wrapper makes it easier for investors to get involved in the fixed income markets, because fixed income doesn't trade like equities. A lot of the issuance trade by appointment only. So this kind of allows more investors to get involved within the asset class.
Yeah, absolutely. We certainly see that. And it's one of the reasons we're focused on our side in growing our ETF franchise. Investors are increasingly looking for transparent, easy ways to access different segments of fixed income markets. And so looking at building an array of effectively building blocks or asset allocation tools is, I think, going to be a persistent theme for fixed income ETFs.
Right, and a big part of this is big data and technology. You can't escape an investment conversation without including both of those. So Jayni, what are some of the new ways that big data and market indexing is helping in fixed income markets?
The part about big data is so critical because that data underpins so much insight that's been used in the bond markets all of this whole time. And what's happening is that the technology actually just fuels that. It just gives it way more power. And what we're doing is we're bringing in information that you would traditionally might not have used in the fixed income markets, equity fundamentals as an example. And then exploring further ideas about fixed income factors. And then again, as I mentioned, the ESG is all about data. It's all about, can we get the kind of clean data that's necessary, and being able to crunch all of that in a way that is insightful and reflects actually some of what active managers have traditionally done for investors. It puts it in the investor's hand.
Mm-hmm. And Steve, from the exchange and technology provider aspect from Nasdaq, when you talk to clients, when you talk to partners, what are some of the products that they're looking for?
Sure, so I like it in two ways. One is really around Nasdaq as a matching engine or a provider of technology for execution. So what's happening is that as the fixed income market is growing and there's more attention put on as well, and also because of the influence of ETFs, which are really an equity vehicle and operate under equity market structure, but hold a fixed income asset class. All of these factors are actually driving toward a harmonization between the fixed income markets and the equity markets. I mean, there's still a while to go. I think Nasdaq is exploring things such as, potentially, let's say, having bonds trade like equities, for example, for more pricing transparency to try to deal with some of the inefficiencies around that at appointment that you're talking to. So, I'd say that's the first part. And then the second part is around, data, as well as also, some of the data that, let's say, for example, the exchanges can provide, as the ETFs trade on the exchange, but also as we are looking to build out, market infrastructure as well, there's going to be a lot of data that comes with it that's also going to be very valuable for the investing community.
All right, and Diana, I think this is a great part to loop you in when we talk about liquidity in the fixed income markets and to build up on that conversation we were having with getting in and out of fixed income trading. So with ETFs as an asset allocation tool, it has to be much more efficient from a portfolio manager perspective.
Yeah, I think that's right. And we're certainly seeing it on our side. Our peers in the asset management space, we ourselves at GSAM, starting to use ETFs to put on and take off risk in various segments of the market in an efficient way is really a new and I think building trend that you're seeing, as opposed to just sort of sitting there and saying, I'm going to use this ETF as a long-term strategic asset allocation tool, the way you might think of a mutual fund, for example. An ETF, by contrast, really takes on more sort of trading power for clients.
Yeah, and I think also continuing on the conversation from a macro perspective, we're seeing a little bit more volatility come back into the market. Clearly what's happening with global central banks acting in concert with each other, yields, and that story over there, fixed income, it seems like it's going to become more active.
Yeah, I think that's right. Certainly we see clients struggling to figure out what to do with the next dollar. It's great if you've been invested in fixed income markets this year to date. You've had a phenomenal year. We've gotten almost equity-like returns in bond markets. So folks who've been invested are excited. Folks who haven't been invested are scratching their heads and saying, with yields as low as they are, how do I actually participate here? And so we're very focused on working with our clients in being thoughtful around portfolio construction, thoughtful around building balanced portfolios. And, for example, I talked about credit earlier. If we're in an environment of continued growth, which we have been, albeit modest growth, and interest rates as low as they are, clients are still searching for ways to find income in their portfolio. And so, can you put on income and do it in a thoughtful way? And so, for example, using some of the tools that we have on the active management side, and using data to really sort of streamline that on the passive side, putting on using credit ETFs that can be a little bit more nuanced, using some of the fundamentals to screen out names that you might not want to own. At this point in the cycle, we've seen a lot of differentiation amongst credit in high quality really rallying, lower quality falling behind. Investors are sort of sitting there saying, should I stay invested? Should I not stay invested? Is now the time to buy credit at this moment in the cycle? And if we can give clients tools that do a little bit of the dirty work for them, to use some of the tools we have on the active management side to cull the names, that can be really powerful.
All right, and Jayni, we'll switch it back to you. Given the volatility and what's happening with the markets right now, from an index provider point of view, how are you helping portfolio managers with allocation?
Absolutely. So, as Diana was talking about a moment ago, some of the ideas that portfolio managers have used in order to manage those portfolios well, we are now able to actually embed some of those strategies into an index form. And so, for example, if you wanted a benchmark that actually was more liquid, previously you could rely on straightforward techniques about size of issuance or recent issuance, but these days, along with the additional data, we can also build models that will help you sort of anticipate some of that liquidity. And so that can be systematic, it can be precise, it can be built into a benchmark, and those kinds of models can inform both the portfolio construction or be part of a strategy that goes into.
Yeah, it's really interesting how indexing is becoming part of the investment strategy benchmark and not just simply a measure for the broader markets.
That's right.
And I think that's a trend that we're going to continue to see. Even you brought up ESG before, as different types of themes enter the market, an index can be constructed for virtually anything.
And I also would say that, you know, especially with ESG, it's a layering that you could do. You could still have market exposure, but you can put on that lens of ESG. We've been working recently on the World Government Bond Index is one of our flagships. We have produced a version that is called Climate Change World Government Bond Index. And the nuance there is that you're just tilting towards the idea that you want to support the climate change that governments are undertaking in order to meet the 2-degree standard in the Paris Accord. And so there you don't have to take a major shift. You're simply layering on this additional perspective in your investing, and you could still get broad market exposure in that.
Steve, I would imagine you're seeing that on the product and listing side as well.
Yeah, I mean, you know, I think that we're seeing a lot of, you know, different thoughtful strategies. So, you know, not just even fixed income volatility, but, you know, there's been some, you know, recent, you know, spates of equity volatility as well. And so what I'm seeing is, you know, looking at the construction of the portfolios, whether it's at the index level or the portfolio level, is, you know, how do we use data? How do we use some of the, you know, increasing transparencies we see within the bond markets, you know, to try to create smarter portfolios that enhance yield, but also try to still promote liquidity and dampen duration. So, you know, from that standpoint, definitely seeing a lot of, you know, a lot of improvements in the ETF industry. And another area I'd like to talk about a little bit also is around market structure. You know, it's been 10 years since the financial crisis. Fixed income ETFs have grown quite a lot in assets, and you know, some people have, you know, wondered, you know, what's going to happen during, you know, like say the next, you know, call it volatility, you know, significant volatility spike in fixed income. I mean, you know, I'd say that the fixed income markets, especially with ETFs, you know, they have been tested. I mean, maybe not to the level that some people would want to see the testing, but you've seen episodes such as the taper tantrum. You've seen the 2014, 2015, you know, spikes in volatility in the high yield market as well. And for the most part, fixed income ETFs have done well. And here's the thing too, the market structure, the market makers that are supporting these ETFs, they're getting more sophisticated. They're learning from these. They're creating better tools. There's more data and information they can use. And they're smart about not being afraid of the risk of volatility, but actually looking at volatility as an opportunity to be able to come in, provide liquidity when the market needs it, and provide that, you know, provide that comfort for investors and be able to profit off it as well.
Yeah, I think liquidity might actually be improved at a portfolio level, whereas you might have seen a drop-off in liquidity or perhaps more variability in liquidity on a single name basis. You know, as we've seen issuance grow and you've seen broker-dealer balance sheets a little bit more constrained, inventories come lower, there's a gap there, right? And so you have seen more variation, I think, in single names, but I think at the portfolio level, liquidity actually might be a little better.
Right, and that was kind of the point I was going to make. And you always hear, oh, it's different than last time. That happened in the financial crisis, it happened in .com, it happened in '87. But I think market structure, to your point, Dana, it is tighter and liquidity has improved. I certainly feel like the structure is very different than it was in '08 and '09.
I mean, you know, from, let's say, I'm not in no way like a fixed income expert like my colleagues here, but I mean, if you think about the risk profile of debt versus equity, and the fact that, let's say, bonds are related in terms of both credit risk and interest rate risk, especially, let's say, if they represent the same company, the same sector, the same, you know, type of asset class as well. You know, there is, you know, there's a relationship between, let's say, being able to trade one bond or a bond ETF, and then basically be able to reference off of other tradable instruments as well to mitigate the risk and understand valuation as well. So that's what I was kind of alluding to, is that you know, that there are better understanding and more data that comes with supporting market makers' abilities to do such. And now you're also seeing a lot of the top proprietary firms, the ones with the most sophisticated tools, you know, the best quantitative metrics. These are the firms that are coming in right now and, you know, really now getting into the cash bond market. So I think it'll accrue benefits for trading the cash bonds as well.
Yeah. Fixed income ETFs, are they typically more actively managed or passively managed just because of the nature of the bonds and the durations and how they don't trade as quickly as equities?
Well, I'll take a stab at this one, but you know, I think there's a broad spectrum between sort of passive to active. You had your original ETFs that were issued in the fixed income market, I would have said were passive. They took an index and they tried their best to replicate it. I'll put an asterisk there. Then you've got active management, right, where you perhaps aren't, your goal isn't actually to just simply track the index. And then you've got this space in between. Smart beta is obviously the sort of the common name given for that broad space in between the two extremes. And that's being defined right now by the market. And every firm out there, every asset manager is sort of defining that space a little bit differently. I would say our approach at GSAM Fixed Income so far is a little bit closer to the passive side than the truly active side, where you might be, from scratch, as I referenced earlier, really reconstructing an index. The other comment that I might make to your point is around replication, right? In fixed income, as opposed to equities, it's harder to just perfectly replicate your index. You're talking about thousands of CUSIPs. And so, a fixed income ETF, we all know this, you're not going to hold every single CUSIP, and that's actually okay. You're going to put together a reasonable, what we call representative basket that's going to give you the key exposures and reduce the tracking error, reduce the differences relative to that index materially, so you get the same effect, but you don't necessarily have to hold every single bond. And that also, I think, gets back to the liquidity comment, helps you manage liquidity in fixed income, which can be a little bit more challenging.
It's also more cost efficient as well.
Exactly.
Yeah.
Maybe one quick comment around like passive and active is that ETFs, as they've evolved, they played multiple roles in client portfolios. You could have active strategies that are the actual, let's say, the actual driver of returns. It is actually the portfolio itself. Whereas some people view ETFs as more of the passive tool, and they'd rather stick to the the passive side, and use the ETFs as a tool. So when you think about like passive and active as well, is that as let's say ETF industries matured, as fixed income ETFs keep maturing as well, I think you're going to see ETFs that are meant to be building blocks and ETFs that are actually meant to be more, call it core or primary holdings in portfolios.
Yeah, that's a great point. We have a couple minutes to go here, so let's wrap up with everyone's outlook, whether it's macro, market structure, product. We'll start with you, Jayni.
There's a lot of talk out there about how long it took for fixed income ETFs to reach the first trillion mark. And a lot of people out there are talking about how that's going to, the second trillion is going to happen in the next 5 years. That says to me a ton of innovation, a lot of focus, a lot of people with ideas that I think over time the industry is going to converge a bit on some of those ideas so that the standards exist and investors can navigate through those. So I see that the next few years is very exciting for fixed income.
I'd certainly agree. Investors for the last, 30 years have benefited from a huge tailwind of falling rates, with some exceptions in there, of course, but really had a tailwind from falling rates over the last 3 decades effectively. And fixed income investing today remains pretty challenging with low rates, as you commented earlier. And growth may well kick along here and be perfectly good here in the US over the next couple of years here. But where does that put the investor? It's really challenging to invest in fixed income markets with yields where they are, with spreads as tight as they are. And so, if we can put portfolios together using more nuanced products on the ETF side that give our clients better exposure, more nuanced exposure, a smarter risk-adjusted return in fixed income markets, I think that's going to be key and hopefully a trend we continue to see.
All right, Steve, last word.
Well, in one word, transparency.
Yeah.
So when you think about the way that the bond market is evolving with more bonds that are going to be trading on screen, you see the growth of fixed income ETFs and also the corollary impact that even fixed income ETF trading then flows over into the bond markets to help, let's say, for example, with bond marking, as well as also the trading of the bonds as well. And then finally, also, with more transparency, people are just going to get a better sense of, for example, the valuations. And so all of this, I think, is going to end up with, promoting better transparency, and with better transparency, I think that you're going to see more confidence in the fixed income markets.
All right, Jayni, Dana, Steve, thanks so much for joining us at MarketSite, and thank you for joining me on the special edition of Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.